Hello and welcome to Likefolio Trade School. This is Nick Fenton. I'm the in-house options specialist and trade strategist for Likefolio. Tonight we're going to be discussing research methods that combine well with social data, aka social sentiment. Social sentiment is an exciting new feature in TD Ameritrade's Thinkorswim desktop trading platform. You can only get it in TD Ameritrade's Thinkorswim desktop trading platform. Therefore, if you aren't a TD Ameritrade member, you should definitely open an account as soon as possible. We have some special account brokerage offers for Likefolio Trade School listeners. So wait till the end of the video and we'll tell you a little bit more about those. For now, I want to tell you about the two things that I utilize along with social sentiment. One being price patterns, just really basic price patterns. I like to keep things really simple because simple works long term. And then the other thing would be implied volatility, which I have shrunk down here at the bottom because we're going to talk about that second. So first, I've got all the shine on the upper chart here, and that's because we're going to talk about price patterns. So what I mean by basic price patterns are support, resistance, trend lines, uptrends, downtrends, breaking trend lines. So here's an example in Lulu. We're looking at Lululemon, LULU is the ticker. And we've got a really solid uptrend intact here until recently we had a bearish gap after an earnings report, and that broke the stock through this otherwise strong uptrend support. So this uptrend support is now resistance. If Lulu is to rally and get back up towards this support turns resistance level, then you have a case to short the stock or put on a bearish option strategy. If you were to recognize that this had taken place, you could combine your recognition of the bearish price pattern setup with social sentiment. And if you found some bearish social sentiment data or trending, then you just strengthen your cause. And by strengthening your cause, you're increasing your probability of success on that trade. Also looking at implied volatility is important as well, coupling that in here, but I'm going to go over that in just a moment. So another strong price pattern, we have Starbucks. Found this one pretty interesting. We've got a solid support intact. So again, very basic stuff. We talked about a trend line break. Now we're talking about a support level. So you can see we have a support right around 54 in Starbucks. It was established right around this area. You don't have to be precise. It doesn't have to hit exactly 54 for this to be a reasonable support level. So you can see in this area, it's tested this 54 level several times. Once, twice, 3, 4, 5, 6 times. And then it came back over here, got near it, popped up. And right now we're right on it. So this would be a bullish signal or bullish potential opportunity here. Is the stock going to break through support or is it going to bounce off support? We don't know. All I know is that I can make calculated risks. And in this case, if I bought here while it's sitting on support, I could either buy the stock or enter a bullish option strategy. If the stock gets down to under 53, I'm going to go ahead and consider my thesis debunked and I'll exit my trade. Otherwise, I'm going to hold it until it gets in the 57, 58 area, till it starts getting into this resistance congestion area. Then I'll take profits if it does in fact bounce and get up into that area. So one more I wanted to show you is Netflix. Netflix, I've already got the channel lines drawn here. We've got support at 85 and some resistance right around 100. Again, it doesn't have to be exact, but you can see right around 100 we've had some resistance. 100 also happens to be a pretty big psychological barrier. That's just a big psychological round number. So a lot of people tend to exit positions when it gets towards that 100 psychological level. But that's another story. So here we have, if you catch it right at or near 100, it's still pretty close to 100. You could consider this an opportunity to put a bearish strategy on. So, right around this level, you could say, I'm going to position into a bearish option strategy, or I'm going to short the stock. And if you couple that with some bearish social sentiment data, then you've strengthened your cause. If you get the pullback all the way to 85, you could say, hey, this is making a case for a bullish trade, so I'm either going to buy stock or put on a bullish option strategy. And if you coupled that with some bullish social sentiment data, then again, you strengthen your cause. So let's talk implied volatility. Let me make that area a little bigger here first. So here we have implied volatility. As you can see in Netflix's case, we have ranged. Let me pull out my channel tool here. I'm just going to mark the bottom end of the 52-week range right there. And then the top end of the 52-week range was all the way back here. So here's our top. This was the highest the implied volatility reached in the 52-week period. And then here's the lowest that it reached in the 52-week period. So essentially you want to use those as your reference points. In the event that your implied volatility gets at or near this high level, that's a good opportunity to actually sell premium. So I really use implied volatility as a guide on how I should approach my options trading. I don't necessarily take it into account much with buying or shorting stock. So in the event the implied volatility levels are at the high end of the range, so let's say right here, we were at the high end of the range, I would most definitely have been selling premium. And the reason I do that is because once it's at the high end of its range, it's more probable that that implied volatility is going to decrease. So if you are a seller of the premium, you benefit from that decrease in volatility premium value. On the flip side, if you see the implied volatility at the low end of its range, at or near the low end of its range, it could be in this area here. That's still near the low end of its range. It doesn't have to be right at the bottom of the range. So if you see it at the low end of the range, it's more probable that it's going to increase, thereby meaning that the value of the volatility premium built into the options price is going to increase in value. So you'd want to be on the buy side so that you could benefit from that increase in value. So if the implied volatility is at or near the bottom of the end of the range, then I'm looking at debit strategies. I want to buy premium in options. If it's at or near the top end of the range, I'm looking at credit strategies. I want to sell premium. I want to benefit from what I expect to be downside in implied volatility's value. So if it's in the middle of the range, which it kind of is right now, it's kind of in the middle of the range right now, I tend to favor selling premium more than buying premium because then you can benefit from time decay. It's a little bit more of a discussion, but as time ticks away, the value of that time premium decreases. It's guaranteed that time is going to tick away. Therefore, why not be on the side where you benefit from time ticking away and that time premium decreasing? So, that's why I tend to be on the sell side if it's in the middle of the range. But really, I more so tend to avoid trading, period, if it's in the middle of the range because it's more of a coin toss. I like to trade when it's at the high end because then it's, I'm very confident that I should sell premium. I like to trade when it's at or near the low end because then I'm very confident that I should be buying premium. So if we had a situation where we were bearish and we had social sentiment signaling bearish and we had implied volatility at the low end of the range, then we might just want to buy puts because the implied volatility premium is cheap and therefore we would expect it to increase. And that means that we'd want to benefit from the increase in value of the volatility premium. So we would just be a buyer of some sort of bearish option strategy. Just outright buying puts might be the way to do it. You could buy a put spread. So, those are two options. One thing that I actually did see here that kind of brings it all together is an actual potential trade opportunity in Apple. So what do I see in Apple? We've got the news behind us. We've got some resistance right here at 110. there's a potential resistance level. You can see it was initially support, then it broke through that support, turning that support to resistance, dipped down, tested that resistance level, failed miserably, and now it's coming back. It's tested it one more time, failed, it's popping back up, it's back towards this testing level. Another thing I notice, so we got the stock sitting at resistance, potentially a bearish trade opportunity. Another thing I'm noticing here is a pretty steep decrease in sentiment. So Apple's sentiment was previously really flat, sitting in between 85 and 95 range. And then all of a sudden, it is totally tanked down to around 70% right now. We've seen a spike in mentions. That's iPhone 7. But more so, just concerning is this decrease in overall sentiment. So I think that's a bearish sign. So we see the stock moving into resistance, potentially bearish opportunity. We see the big drop in social sentiment, another kind of adding to the strength of our bearish case. And then we look down here at implied volatility. Well, the implied volatility is, at its highs has been up here at around 45%, and at its lows has been down here around 15-16%. Currently it's at 20%, so it's way closer to the low end of the range. I mean, it's pretty much at the low end of its range. That tells me there's an opportunity to buy premium. So again, we could just outright buy puts. We could buy a put spread, something along those lines. So I think that makes for a pretty decent trade opportunity here in Apple right now, just as a real life example of how we could couple all this stuff together. So those are basically the two things that I combine with social sentiment data. Implied volatility is really important for me to determining which type of option strategy I should be doing, whether I should be doing a credit strategy or a debit strategy. And then overall basic price patterns are very important to me to kind of get an idea of what sort of directional play I want to make. So, getting too fancy with these price patterns or really fancy technical analysis tools, technical indicators, I just never had luck with that long term. Keeping it simple, keeping it basic really has benefited me in long-term trading here. Implied volatility is a forward-looking indicator. That's awesome. Social sentiment's a forward-looking indicator. Awesome. Price patterns are lagging indicators because you're basing this off, you're basing this resistance in this particular case off previous reactions at certain levels. Doesn't necessarily mean it's going to have that same reaction again, but at least it gives you a visual idea of, which direction you should consider playing. Which direction might be more probable for the stock to go at its given level. So in this case, I feel it's more probable that Apple pulls back a bit here because it's tested this 110 level several times and failed. It's not rocket science. It's not going to be right every time. But hey, it certainly gives me a good calculated risk, gives me a good reason to put the trade on, and it's just some more increases my probability of overall success in the long term. And that's the real point of this game. You want to be successful long term, not just successful on this one trade. So that sums this up. Don't forget to go to TD Ameritrade and sign up if you aren't already a TD Ameritrade member. Hope you found this insightful. We'll see you on the next one. Special pro tip alert. Visit learn.likefolio.com. We've got more Likefolio Trade School videos, all exciting, jam-packed with education, beneficial, actionable, awesome. Also going to have a special brokerage offer for you, so make sure you visit.